These days, it seems like we're bombarded with financial advice wherever we turn. The traditional stockbrokers, a thing of the past, the boutique firms, the new norm, and robo-advisors seem to be gaining popularity. It's hard to know where to turn, so these are 4 things that you need to know the next time you meet with your financial advisor. Independence is key. Many advisors are only independent to a certain degree, meaning that they own their own office building, but they're supported by a much larger firm. In cases like this, advisors can only recommend certain products and strategies, which isn't truly tailored to you. Now, a truly independent advisor is called an RIA, or Registered Investment Advisor. Is yours? Risk tolerance always seems to be the elephant in the room. How do you take something qualitative, like aggressive or conservative, and turn it into something quantitative? You can't just walk down to the stock exchange and say, I want to buy conservative today. Translating these 2 concepts is key because you never want to find yourself situated in a portfolio that's not meant for you, especially with the volatility of the market today. Mutual funds, stocks, bonds, small cap, large cap, there are so many options, and yet not all options are created equal. Many advisors will push funds that their parent firms have a close relationship with, or ones that have a high sales charge. But this benefits them, not you. What's in your portfolio? Diversification is a word that gets thrown around a lot, but I'll give you 2 words that aren't. Correlation coefficients. Did you know in many cases a well-diversified portfolio isn't actually diversified at all? Many asset classes that seem diversified at the surface actually move together, and when an event occurs, like in 2008, many investors who feel that they were safe or diversified come to the sad realization that they weren't diversified at all. Some advisors are paid through commission on the products they sell, while other advisors are paid based off the amount of money that you have with them through fees. These fees can add up, and just because you're paying for their services doesn't mean they necessarily have to make you money. Now, how does your advisor expect to be compensated? How do his or her fees fall within their peer group? How many times a year do you expect to meet with them? And are things like financial plans included in the package? All of these questions are more than fair because it is your money that you worked hard for, and you deserve to make the most out of it that you can. Finance is one of those fields the professionals try to keep purposefully confusing to keep you in the dark. But those days are over. An educated investor is an empowered investor.